What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is August 22nd of 2019. Well, folks, I hope you are having a fantastic day wherever you are, and in today's video, we've got a variety of key topics to focus in on. We're going to start off by taking a look over cryptocurrency markets and asking a lot of key questions, such as where we are in the current cycle, as well as whether or not we can expect a shift in altcoin dominance over the coming weeks. And then outside of that as well, in traditional markets, we have not only talked about the ballooning issue of corporate debt on the global economy, which has reached trillions of dollars in record highs in the past year, but along with that, a new problem within the corporate debt sector, and that is negative yielding corporate debt, which just reached $1 trillion. We are truly living in the twilight zone, ladies and gentlemen. However, before we dive into this really interesting update, I want to share something with you guys that I've been working on for a while. I know a lot of you out there have been trying to find an alternative to Binance as they're shutting off to US clients in September. And along with that as well, things that bring about new income generation opportunities for your crypto, bringing you more financial sovereignty. And then also, I think what's most important, becoming your own bank and managing your own keys, but making it simple at the same time. Well, that's what I'm currently working on right now. I've been working on a startup for quite some time, and there's a link down below which is basically titled Banking for the 21st Century. If you guys are interested, definitely sign up for the email list here. I want to keep you guys in the loop of what I'm working on outside of the channel. I think it's a really exciting project, but I'm not going to bog you guys down about it. If you want to learn a little bit about a brief kind of analysis of what I'm working on, feel free to check out the brief description and then stay tuned to the email list. I'll mention it from time to time, but I'm not going to bother you guys with it too much. It's something, though, that I really think is going to help evolve the cryptocurrency space and also bring in a lot of new people into crypto that haven't been able to get crypto before. Alrighty, so let's go ahead and take a look across the board of the market. As we saw just a few moments ago, Bitcoin's slightly down. However, we're starting to really see across the board some positive tone on some of the plays we've been watching. For example, Basic Attention Token leading the market right now, but also some really prominent altcoins such as Ethereum Classic and Icon starting to finally get some love in the market. But again, across the board right now, most cryptocurrencies are in the green with, again, just slightly out of a no trend scenario trend in the market. Now, if we take a look here at global market cap, again, just a slight bump up here in the past few hours, nothing too serious, about $1 to $2 billion over the last 24 hours. If we take a look here at market dominance, though, this is what I really want to focus in on. Now, as we take a look at Bitcoin's price later on, we'll see that Bitcoin is still remaining very strong for the year, guys. I don't want to make this sound as if Bitcoin's faltering out. In fact, even though it hasn't gained in market dominance, Bitcoin really hasn't lost much market dominance. It's down like 1% from its high. It's basically pushed sideways at the moment. With that being realized, I do love seeing flattenings in the sense of trends in this case, because it usually means that this is a potential break point where we could see a shift in trend. Now, as much as I agree, guys, there's still a lot of faulty altcoin valuation out there. You're not only going to see a lot of that circulating to real projects, but also Bitcoin has been on a pretty big tear here over the last few months, and I think we are going to start seeing some risk taking very soon. Again, I'm not saying it's guaranteed. This is just, again, why I'm starting to hedge into some different positions outside of Bitcoin. I have my Bitcoin position. I've been adding a nice diversified range of investments in the crypto space, guys. I don't put all my eggs in one basket. That being realized, when I start to see lowering highs here in this case in the sense of dominance and a flattening at a very big even level, which bear in mind was the resistance in Bitcoin dominance before we entered into the first altcoin rally in 2017, where we saw the likes of XRP, Ethereum, Litecoin, some of the big plays that are still here today start to eat up that dominance in the market. We're now back in a position where there's a lot of room for altcoins to potentially see some higher reward in this case, okay? So again, there's no guarantee of it, but this is one of the key significant indicators that I'm watching right now. And so long as we can't get past 70 in this case, I think we're in a zone where we can start to have a pretty good kind of risk to reward ratio. If you guys are trading in the market, a way that I would look at it is I'd say, for example, if we have a breach above 70% market dominance, then I close out of the altcoin positions in this case, or at least for the short-term ones in this case. If you see what I'm saying, if you were to just actively be trading in this case, you have a very low risk in this case, but also potential high reward for altcoin cycles, which move very, very quick. That's the kind of thesis on it. So anyways, you guys do what you want. I don't want to try to dictate or tell you what to do. But taking a look here in the sense of Bitcoin's price, I'm liking the fact that we're setting higher lows here ever since back here in the later part of July, almost a month of worth of price action here, again, setting higher lows here. And we're holding support here on the 100-day moving average, which is really, really nice. Now, we talked about in my last video, I think it was the last video I put out where I talked about the 21-week moving average. Again, that is going to be the indicator that I'm watching as well here. We might continue to push sideways. We might break through this 100-day. I wouldn't doubt it for a second. And not only will this be good in the sense of prepping for the next part of the cycle here, but also it's going to give us some confidence in the sense of being able to build a higher base. In this case, you need to be able to do that for these kind of rallies, especially when you have a near 3 to 4x in the sense of market valuation, right? I mean, when Bitcoin moved 3 to 4x in this case from its lows down here, you have to have those kind of ranges of support, especially if you're not going to come back to what everyone was expecting, which was 6K down here. You know, that was what a lot of people were thinking, is we needed to come down and test 6K and make, you know, previous support again, right? So anyways, so that's really what I'm watching at the moment. I'll be watching whether or not it holds here on the 100-day moving average. But again, I'm not going to really get too confident about, you know, averaging in just yet until we get a close above both the 21 and 50-day. That's when I think the momentum might kick back in and we'd really start to see a breakout of the wedge here. Okay, in the sense of overall assets, as I talked about, you know, we're seeing a few exceptions here starting to enter into the green here as altcoins have started to gain a little bit of dominance. Again, nothing significant. There's a few kind of key players as we took a few moments ago. One of our players, BAT, was doing really well today. But we're again seeing markets relatively flat for the week here as Bitcoin has been, again, pushing sideways. Nothing, you know, fearful, nothing extremely exciting. Again, we're trying to build base support here, guys. Now, a lot of people out there would probably want it to be put in an analogy of some sort as to where we are in the current cycle to put some perspective into things. And, you know, I think, for example, as the topic of this article here focuses on the fact that we haven't hit a top yet, I 100% agree with this. I don't think we're at a market top at all. And some people are saying this is a B wave or something, that it's going to go down back to 3K. No, I don't think that's the case, guys. There's too much momentum right now in the market. There's too much fundamentals that people are looking forward to that is going to evolve and further push cryptocurrencies. We have entered into the next 4-year cycle. I think that's pretty much agreed upon by most people. But the thing that I want to clarify in the sense is that we are not so much in the bull run just yet. We're not in the next cycle where we've passed previous highs of Bitcoin and are going to see 3, 5, 10x in this case where Bitcoin really multiplies. Where we're at right now is the exit out of the accumulation phase. And to put a similar kind of date range for you guys to turn back to and look at in the sense of previous price action, this is basically where we were back during the spring and summer of 2016. Right before we stepped into 2017, revisited the previous highs and rallied on all the way up 20x in value for Bitcoin. So again, that's where we're at right now. We're in the exit out of the accumulation phase. And you can technically call it a bull run if you want. The reason I don't call it a bull run is because in Bitcoin, it's a very repetitive cycle in this case, where it's very cyclical in nature. And you can see it's this repetitive pattern where we tend to break out amongst the previous highs and then we really start to take off. Some people correlate with the block halvings. You have as well, that's mentioned, much larger increases in the hash rate and also participation in the community as well. A lot of retail investors, some institutions coming in. Again, it's standard to come with each wave in this case. So to provide some perspective without having to dive too deep into the charts, you guys can see it what I mean if you take a look at it. We were at this period where we were starting to press sideways during the summer and then continue to pick up and revisit the all-time highs in both the fall and winter of 2016 in that case. And that led us to 2017 where we had a short-term correction and then continued on to the rally throughout the rest of 2017 and had a really great year for crypto markets. That's what I'm thinking 2020 is going to be for us in this case. So I'd like to know what you all think about this. What do you all think about the potential for us to be at that same kind of price range? Go take a look at the chart if you guys get the chance. Let me know what your thoughts are. If you agree with that we're in that same range or that we're well beyond that or actually below that by chance. Maybe I'm being a little too conservative in this case, right? You know, it might be the other case. So anyways, would like to know what you guys think about it. Now, one thing that I do want to point out, and I think is very significant to take into account, is Bitcoin in the sense of Google Trends. Google Trends is a great way to get an assessment as to whether or not retail investors are getting interested in Bitcoin again. And The thing that's important to note is that you want to set your date range right. I like to do, for example, generally speaking, January of 2009. It's really the first kind of period of time where you could get any kind of information on Bitcoin. I mean, it was still pretty much non-existent at the time, but this is again when Bitcoin actually started to come live. The network was alive. And you can see here that the peak was obviously back here in December of 2017. This is when the highest rate of trend was on the topic of Bitcoin. But we've now started to see, as Bitcoin's price has increased, we've obviously started to see more people getting on board. And again, we're back in a range where we were back here during the fall of 2017. This is very fitting because we're at the price range where we were around this time period, around October and November. Not to mention as well, again, retail participants are not going to be searching as much for Bitcoin for kind of two reasons. One, some already own Bitcoin and they're not really looking up much into it after they already know about it and own it. And then second off as well, retail investors who got interested around this time frame will only get interested again when Bitcoin is at a much higher price, because sadly that's how markets work. Retail investors usually get in late, at least a good amount of retail investors. So a lot of that growth that we're expecting is going to come later down the road. So hopefully that makes sense in that case. So we're exactly where we need to be in the sense of Google Trends right now. Some people are like, oh, we're nowhere near where we were back in, December. It's like, well, of course, like there's not the hype around it, right? So again, you need to have really parabolic rallies to get new retail attention. Now, I want to spend some time to focus in on corporate debt, because I not only have talked about this previously on the Data Dash channel, as some of you might know if you're active viewers, but along with that, I'm not so much just concerned in the sense that we've reached $9 trillion in corporate debt. This was actually written a while ago, so I'd assume we're getting close to around $10 trillion, as this was back in November of 2018. But even at $9 to $10 trillion, corporate debt might not be as big of a domino as we think it is. As we all understand, if you guys understand credit creation, things of that sort, you'll know that there's always going to be more debt, or more credit in this case, than there is money in the economy to pay down that debt. It's just, it's finance 101. A lot of people don't know about that in finance, but it's true, right? It's the truth of the matter when it comes to debt. But I'm not so much concerned about this. I'm concerned about the growing fraction of corporate debt that is negative yielding. Now, we have talked on the channel a lot about the continuing growth in negative yielding bonds across the world that has reached $17 trillion in total. That's the overall negative yielding bond market. And corporate debt is playing a role in that right now. It just reached $1 trillion in value. So why is this significant? Why is this, as much as it's a much lower valuation than overall corporate debt, why could it be the domino to bring down this whole thing? Well, the reason why is because negative yielding debt cannot last forever. This is a new kind of monetary or financial experiment, whatever you want to call it. This is not something we've seen before in significant numbers in history, okay? The reason why this can't sustain and why we've been seeing this growth of negative yielding debt, people even buying negative yielding debt, it doesn't even make sense. The reason why is because they're buying it for short-term gain, right? They're shoving this either into pension funds, your retirement portfolio, or they're buying it themselves as traders, because it tends to be that when yields are declining, prices tend to go up on bonds. They work in an inverse way in this case. So if bond prices are going down, yields are going up, right? So as we continue to feed into this kind of, I don't want to just call it a Ponzi, but it really is at the end of the day just this kind of false assumption that this can keep going up. The fact of the matter is that eventually we're going to get to a point where people believe the risk is too high to buy these bonds, and they're likely going to go to zero, because no one wants to hold a bond that's negative yielding, outside of a few traders in this case. Not trillions of dollars. There's no multi-trillion dollar demand for negative yielding returns, okay? And that's what's going to lead this domino to collapse. It's going to lead the negative yielding corporate debt to knock down a whole sector of corporate debt. This $9 to $10 trillion of corporate debt in total will be knocked down due to the distrust and the absolute decline in the negative yielding debt that is going to hit through. I won't guarantee it, guys. I have no doubt. Who knows? There's maybe some crazy thing I'm missing in this case, but it makes logical sense to me that that would happen. And if you guys want some visual representation as to how fast this is happening, just at the beginning of this year, we only had $20 billion of negative yielding corporate debt. We're now over $1 trillion. And this is just corporate debt. This is not including government bonds, other forms of debt that might be negative yielding. To think that in a matter of 2 weeks, we have gone, actually, I think it's even less than 2 weeks, we've gone from 15 to $17 trillion in negative yielding debt. We've added $2 trillion in new debt on the global stage, and it's negative yielding. That is extremely concerning. And you could go ahead and speculate and play with this all you want. You know, there's ways you guys can trade on these bonds. You can bet on them. You can bet against them, whatever it may be. All I know is that I want to have my positions in hedges where liquidity will flow to if this becomes a disaster and eventually pops. I am highly confident we're going to see that. But again, who knows? I'd like to know what you guys think down below in the comments. Do you see eye to eye on this? Do you see that $1 trillion of negative yielding debt does not make any sense? Maybe it's just me. I don't know. Anyways, I hope you all are doing well wherever you are. Thank you guys so much for watching. And again, I don't mean to press it too hard on you guys. If you want, check out bankingforthe21stcentury.com down below and stay tuned for the announcement of my startup I'm working on. I've got a lot of interesting things to show you guys in the next coming month or so. But until the next video, I'll see you all in the next one. Stay tuned.